Okay, everyone, welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm joined by Bill Bymel, who has a long history in the industry of Spurs Capital. So, Bill, how's it going?
Good, Dan. Thanks for having me.
Yeah, no, thank you very much for coming on. So, I was really excited when you had, responded to my request and said you were willing to come on. So, I think this will be a really good talk today. So why don't we just start by, talk a little bit about your background and kind of how you found the note mortgage industry.
Sure, no problem. I moved to Florida, back to Florida in 2002. I was living in Los Angeles and had a place in New York City. I was pursuing a career in the entertainment business, believe it or not, and moved back to Florida temporarily. Really, just came back with the intention of spending some time with my parents. And next thing you know, I was starting to buy and flip houses. I got my real estate license, and more importantly, I met a woman, fell in love, started a family, and so the rest was history. About 4 or 5 years into my real estate practice, I moved into commercial real estate, hooked up with my partner, Nate Werner, at Retail Sites International. We do tenant rep work for major restaurants and retail chains here in Florida. And then in the summer of 2008, about 3 months before the fall of Lehman Brothers, I received a phone call randomly from an asset manager for a private equity fund based in Southern California. And he was looking at 2,000 non-performing construction to perm loans on brand new houses in an area of South Florida known as Port St. Lucie. And for those who follow the foreclosure crisis and were around back then, Port St. Lucie was really one of the ground zeros for the crisis. You had tons of speculation, a lot of out-of-town investors, guys that were calling me from California that were now buying these loans at a discount. Some of those were themselves borrowers on these speculative home constructions in Port St. Lucie, which the bottom had fallen out on the market and everybody was going upside down.
Yeah, I know that area fairly well. Actually, my aunt lives there now, and my grandparents had lived in Jensen Beach for years.
Oh,
They
right.
actually bought a place in Jensen Beach in 1972.
Yeah, it's a cute, quaint area. It's about 35, 45 minutes north of Palm Beach County. So that puts in Palm Beach, as you know, is about an hour and a half north of Miami. So it puts you pretty far into, I wouldn't even call it suburbs, I mean, of Miami. It's pretty far from the major metropolitan areas, but it's an
Yeah.
affordable place to live. What didn't make sense in 2008 was all of a sudden this affordable place to live where you used to be able to buy 2,000 square foot houses on your own lot for $150,000. All of a
Yeah.
sudden in 2007, folks were paying $100,000 for a lot, building, getting 100% financing construction loans, putting another 200,000 into a house on those lots. And so they were owning these houses that no one would buy, that they'd sunk $300,000 into. And it just, the whole house of cards kind of fell at that point.
Yeah, and I grew up in Melbourne, Florida, another, hour and a half or so north of that. And I saw a similar thing where, growing up, there were houses, especially near the beach. It was like you could buy a house on the mainland for 100,000 or on the beach for like 120, and maybe it would be like an older fixer upper. And then all of a sudden, those $120,000 houses were going for 300,000 and 400,000 just in a span of a couple of years, and nothing really changed.
Right, right,
Just,
right,
yeah,
exactly. So that was a light bulb moment for me. I mean, we all at that point in 2008 knew that something was on the horizon financially. And then a few short months thereafter, Lehman fell, Bear Stearns, and then we were knee deep in a foreclosure in the financial crisis of 2008. I got a little bit of a head start on it. I got this phone call. They were looking for somebody who knew the area. And that was a light bulb moment for me. So I was really it was a wonderful opportunity in the face of obviously a very sad time for many borrowers,
Yeah.
but it was an opportunity for me, and I saw that the writing on the wall, and I jumped at it. And they say opportunity only knocks once. Well, it knocked in this situation. I started RSI Asset Management January 1st of 2009. That fund manager who had was bidding those loans, we had spent the summer of 2000, fall and winter of 2008 bidding on this portfolio. And I think we ended up, I think the ultimate seller to us was a National City Bank, which now is, of course, no longer exists.
I think they had my mortgage when I lived in Florida, if I remember. That name rings a bell. I think
Yeah,
they
I'm sure. Yeah, they're a very big South Florida lender,
yeah.
or Florida lender. And so we jumped right into it. We were doing consulting for this hedge fund. I ended up starting to buy notes. The relationship was such that there was sometimes throwaway deals, meaning that there was a lot of work in them, and these funds would then want to they were getting such bulk pricing at the time. If they paid 20 cents or 30 cents on the dollar, and they could turn around and sell it right away for 40 cents on the dollar, that was still a good deal for us as local investors. So we bought some, we managed a lot, and then about 2 years after about 2 years of track record with jumping around to a couple of these private equity funds, working with groups that were on the up and up like Arch Bay or Condor, I met a gentleman named Peter Slagowitz, who is the CEO and founder of Spurs Capital. He had founded Spurs right around the same time I got that random phone call from the fund managers in LA. And he raised $50 million initially for Spurs' first flagship fund. We've now deployed about 750 million under that fund to date. And at the time, the strategy was focused on judicial states, focused on the harder to work states, and New York, the tri-state area around New York, Illinois, some of the states in the Midwest, Florida, obviously. So he was looking for somebody that had experience in NPL and an understanding of the residential real estate market in Florida. So it was a match made in heaven. I started out managing the Florida assets in this Goshen portfolio. We started to branch out, do some fix and flip strategies over the years. We bought bulk numbers of houses, single family homes in Jacksonville, South Florida. We've obviously bought a lot of NPL. We bought some performing loans. And then about 2-3 years ago, I was promoted to a managing director position. I'm a signatory on a number of the funds. And I now take on somewhat of a business development role for the company as well, as we've now started our second, third, and fourth funds. Our second fund actually coming to a close. Our third and fourth funds we just launched at the end of 2018 and are excited to report that the industry is still thriving.
No, that's good. So, and on those funds, like how long do those last? Are those like closed-end funds with like a certain time horizon? Or?
Correct. Well, three of our four funds don't have a close date. They're not closed end. Because they each have one single investor. It's afforded us the ability to set up an LLC, open-ended, and ultimately we had a certain allocation of money that, as long as we meet a certain modeling and go through the rigorous due diligence that we go through, we can allocate that money to this strategy. And we work with those single investors on each of those three funds to greenlight and buy and sell deals and manage that. So the number 4 fund, which is our SC Park Lane fund, is our first semi-closed end fund. In other words, it isn't closed end in the traditional sense that we're filling it up certain period of time, closing it. It is in the sense that we are signing side letters with investors. We have a number of LPs involved in that. That one's open to high net worth, family offices, friends and family. We've got about 25 million in that fund right now, and we do sign promises to return the money on a 2 to 3 year time horizon. But we expect there to be an optionality to reinvest, and most of the people that come along for the long haul with us.
Right. Yeah, that makes sense. And then you talked a little about, investing in states like New York. I mean, what's interesting about you guys is you go to all the places that a lot of people try to stay away from. Like I've always been advised, to watch out for like states like New York, New Jersey,
Right.
and the Northeast. And I know for me, I've kind of tried to take the path of least resistance and for
Right.
the most part of state and easier states. What does it take to be able
Yeah.
to operate successfully in some of those tougher environments?
We're like the firefighters running into a burning building. I don't know why we do it, but we do.
Yeah.
Actually, it's in retrospect, I can't take this credit all on myself. Partially for me, it was about knowing the Florida market. So being comfortable with either as an investor or as an advisor and manager in an area where knowing the underlying value of the collateral and the real estate, whether you're buying first lien, second liens, or fee title real estate, the key is knowing the right value, right? I mean, you make your money on the buy. But I give Peter a lot of the credit for the vision on this. He said, we're going to go after the New York tri-state area and Florida. We're going to work these harder to work states. One, we're going to have less competition to buy product. Two, when we buy product, because it's the areas that sellers don't want to get rid of and there aren't as many buyers for, we're going to get much better pricing on that product. So whereas something in California or Texas that trades at 90 cents on the dollar as an NPL, something in Florida or New York trades in the 50s or 60s on the dollar. And so that spread and the ability to buy at such a deep discount comparative to these easier to work states was obviously something that we were looking to take advantage of as part of our arbitrage, right? And we have boots on the ground in these states. So we knew going into it that we needed to build a better mousetrap than our competitors. We needed to be a liquidity provider to sellers that wanted to get rid of product in this market. And by being an expert in this field, we also saw a longevity to this business. And that is where the real genius of Peter's concept has paid off. Because whereas many of our competitors in this field have been, now that they're done with the low-hanging fruit and they can no longer buy in states like Texas and California in the scale that they want to buy in, a lot of them have departed the business. They can't make it work anymore. The margins are too slim. There's not enough product out there. You've got big money chasing small numbers of deals comparative. So by staying an expert in a field, in an area of the business where others are less inclined to go, it's lengthened our ability to keep an ongoing business and to have an endless array of product being offered to us on a monthly basis.
Yeah, and in a state like Florida too, I know it's been cyclical for years. When I was in college, I took this course on Florida history, and they talked about the real estate boom and bust going all the way back to the 20s.
Right.
So when you do get through the next cycle, you'll be really well positioned.
Yes.
More to take even more advantage of that.
Well, one of the new businesses that business lines that we've initiated in the last few years is taking on more third-party clientele. And I won't go into all the names, but we have some serious 800-pound gorillas in this space, guys that you would consider to be some of the best, the more reputable investors in the NPL and distressed asset space, coming to us to subservice, sub-manage their New York and Florida portfolios, because they know that if we can speed up their resolution time by 9 months or 12 months, that's a 5 to 7% savings on the bottom line. So that's actually been the largest growing aspect of our business the last few years, is taking on third-party work from some of our competitors. our counterparties in this business.
Yeah, because having the right team on the ground is crucial. I mean, that's a lot of the reason why I've never bid anything in places like New
Right.
York. I don't know the area and I don't have the team, and I know it's kind of hard, so I haven't wanted to put the time in to develop that
It is
myself.
hard. It's hard in so many ways, especially in New York. I call it hand-to-hand combat, really. It's like guerrilla warfare because you have so many people out trying to make a buck, and everyone's, got an angle. And when you think you've seen it all, there's something new that comes along. The prevalence of what we call deed rats is so high in New York City. Deed rat would be somebody who comes along, and you can only do it in a market like New York because the value of the real estate is so high. Just owning a rental stream on a piece of property in New York has value. We've seen that. So what guys do is they go out and they see somebody in foreclosure or upside down. They're in New York, so they know that a foreclosure is going to take several years, and if they play their cards right, they could really drag it out. So guys go out and find homeowners who are underwater, pay them cash to walk away, hand over the keys and a quitclaim deed. They take a title to the property and start renting it out. And in 6 months, they're in profit margin. And, so it's a big, huge scam that goes on in New York. And maybe scam is the wrong word, but I think it's close to it. And so knowing the law, knowing how to work, what judges to work, what courts to work, knowing to be at the case management conferences and showing up with modification offers in place, because borrowers, they'll go before the judge and they'll lie. I mean, it's amazing how much lying we see going on in these courtrooms by borrowers, saying things like they never offered me anything, they're not working with me. They think they can use headlines from 2010 as their excuse as to why they shouldn't be foreclosed. And as long as we're one step ahead of them, then that's why we have better results than most in the business.
Now that makes sense. Yeah, and they definitely will say crazy things in court. I have a friend who had a horror story where he had a scheduling mix up and didn't have a representative in court, and it was just the borrower, and the borrower showed up and lied about everything, and it got tossed, and so it set him back and cost a lot of money. It was a big pain. I mean, what are some of the longest times you've seen borrowers drag out a foreclosure in a place like
7 years, 8 years?
Oh wow.
Usually when it gets that long, it has to do with mistakes that are being made by the bank. I saw we owned a loan that hadn't been paid for 12 years, and on a technicality, the last owner of the loan got the case was dismissed. So we had statute of limitations concerns in that one, so we actually had to reissue a demand letter that was inside the time of the statute of limitations and bring it to trial. But it's not uncommon to see a very smart borrower drag these things on for 3, 4, 5 years at a time. And a lot of the stuff that we buy ends up that kind of stuff that the previous guy just gets sick of, and that's where opportunity lies for us, right? So that's where I can buy it at a level that it's cheap enough for me to make a home run if I get lucky and do my job right, but also cheap enough that it hedges against the possibility that this borrower or their defense attorney is going to do the same thing to me and drag it out for 2 years.
Yeah, it seems like a much tougher game when you're dealing with those more it seems like not only the rules are different in places like that, but the borrowers are more sophisticated, and
for sure
property values are higher. Like I deal a lot with like contract for deeds in the Midwest, and you don't really run into that kind of stuff.
Right. Well, it's interesting. There was a time, being in Florida, I don't know if you remember this, but there was a time from about 2010 to 2014 where if you drove down I-95 in South Florida, every billboard was foreclosure defense law firms.
No, I had moved to Colorado by then. I moved down to the fourth, so I didn't see that, but yeah.
I mean, it was big business, and right after the crash, and for a number of years thereafter, a lot of these guys have gotten shut down for you know, shady practices, but some of
Sure.
them have done their job very well.
No, it makes sense. And we'll talk next about, so you also wrote a book on note
Yes.
investing, right? Win-win rev.
Yeah, I can tell people that I literally wrote the book on loss mitigation in the residential NPL space. Although I
Nice.
never would have enough ego to actually say that.
Yeah,
Although I just did. So what am I
right.
talking
No,
about?
that's good. But yeah, and I haven't gotten through the entire book yet, but I read a good portion of it. And I like how you go into a lot of the, borrower psychology, and there's a lot of good information in there, for people who are kind of new to note investing that they may not be aware of.
Sure, sure. I wrote published it about 2 years ago. It's on Amazon and Barnes and Noble both.com. Win-Win Revolution is the name of the book. And the idea was to be an easy read, less than 200 pages. Most people have told me that it's taken them in a couple of hours and they're done. And the idea was to share my life experiences the last 10 years in this business, because there are some very interesting people that you meet being in this business, and there's
Oh,
some
yeah.
very heartfelt and uplifting stories of resurgence and people moving on with their lives after what was a very difficult situation for many people. So I tried to share personal stories that I had with interactions with borrowers, lawyers, etc., that could also be the pros and cons of the business and the warnings for potential investors, that could share some insight into some of the potential roadblocks you will face as an investor, and to also be just an informative kind of how-to book. What are the options available to you? What are the things to keep in mind as an investor in the NPL space? I've only really invested in first lien mortgages, non-performing loans, paper that has some level of quality to it, the response has been very good to the book. I hope it shares some good stories in it.
Yeah, I mean, what I like about it is, as you said, it is kind of an easy read. It goes fast, but there's a lot of good meat in
Right.
there. A lot of people like send me books from different folks. They're written and they're short, and a lot of them, are kind of light on content. I mean, this one had a lot of really good stuff in there that was super valuable.
Well, I appreciate you saying that. That was the intent. I'm not out to sell, any other services. It was really my gift to the world. And the book's called Win-Win Revolution because what it ultimately outlines is that just because you're buying debt and you're buying lawsuits, it doesn't make you a nasty litigator or a nasty debt collector. There's another way to skin the cat. It's actually the perfect scenario where we have private equity that allows us to buy debt at a discount to face value. And most of the people we come into contact with either have a suspicion that we are getting it at a discount, or or they know, or they've read the headlines that this debt's been sold off so many times. So we actually really focus on establishing a completely new relationship with the borrower than that they had with their previous lender and servicer. It's the first thing we say. We're not Bank of America. We're not Wells Fargo. We're here on behalf of the investors themselves, to see what we can do to make a difference in this situation. We know that there's an inevitable finish to a situation where you take a loan that's first lien on a house and don't pay off that loan. And the inevitable finish to that is a foreclosure. I have yet to meet anyone in my life that has gotten a free house when they've signed a first lien mortgage. Maybe they've delayed foreclosures. Maybe they've been able to make the note's unenforceable and cloud title forever or whatever. But I've never seen that happen. So we know the inevitability. There's no reason to have to hang that over the head of the borrower. They know it exists.
Mm-hmm.
And I'm not going to call up a borrower like my servicer is going to have to follow CFPB guidelines. They're going to have to follow fair debt collection practices, which we all are extremely trained in ourselves. We're all very aware of what fair debt collection practices are. But they're going to ultimately get to a point where they're going to say, okay, you owe us $40,000 in arrears and escrows. How would you like to make a payment? Well, if the borrower couldn't make a 1 month $1,500 payment 2 years ago, how's he going to make 2 years of payments? It just becomes a snowball effect. So we look to change the conversation away from one of debt collection and one of resolution. And in doing so, we actually turn to these borrowers, these folks that owe us money on paper, and say, what do you want to see done here? And when you do that, when you say to a borrower that owes you money, how do you see this finishing? That's a very different conversation than one that they're used to having in the past. And it really opens up a whole world of possibility. And you ultimately, it makes it, if they're willing to sit there and have a real serious conversation, we're willing to treat them with dignity. We're not going to sit there and harp on the fact that they owe us all this money and they were a bad borrower, or anything like that. We reestablish a new relationship and we look for a solution together, and that's why we call it a win-win.
Yeah, and a lot of these borrowers too that I've talked to, I've had a lot of those similar conversations, and a lot of them are frustrated because they've been dealing with banks or larger institutions. Right. And I've had more than one borrower who was just really happy that they could actually talk to somebody on the phone,
right,
who would, listen to them and take that approach of, well,
that's right.
What do you want to do here? What are your plans? And then actually have the ability to make decisions.
Correct.
Pretty quickly. They're not dealing with a black hole. And so
Correct.
Folks really appreciate that for the most part.
You see this in the mediations a lot too. I mean, I actually have a very high rate of resolution when I come to mediations, and most attorneys and mediators, we're forced into dozens, hundreds, thousands of these mediations over the last 10 years, and the people that the banks send are a rep of a servicer that has no authority to negotiate. And so 99% of the time, they're a waste of time. So just these little tweaks, these little things that we do different, I think has been the major driver for our success in this industry.
Yeah, for sure. Yeah, it's kind of amazing what you can do in some of these situations and how fast they can go.
Right.
Sometimes.
Yeah, absolutely. I mean, we've had situations that, it happens every day. It's what I do. And it's actually very exciting because you never know what a new day brings. But we boarded a new set of loans we bought last month. I go in to look at the file and I notice that the property is on the market as a short sale for like a couple of months now. And I say there really wasn't any conversations in the servicing log about it or anything. Nobody bothered to, I guess, look this up before. So I called up the realtor and lo and behold, she had an offer in place. She said that she couldn't get the previous servicer to respond. She'd actually sent it to them. They couldn't even get out of their own way to consider it. Instead, that investor ended up selling us the loan at a steeper discount than what he would have had as a short sale approval. And we're turning around in 30 days and we're going to make 25% just approving a short sale that was just sitting right there waiting for someone with a brain and eyes and a little bit of digging to get into and find a resolution to.
Yeah, you can get a huge edge in this business just by kind of being on the ball and being able to pay attention. I mean, I worked for a lot of big companies, so I know how that is within big companies a lot of times. But yeah, you can get a big edge just by responding, like I said, paying attention to everything and putting your eyeballs on them.
Right.
Cool. Well, thanks so much, Bill. I think this is probably a good stopping point. I'd like to have you on again at some point in the future as well. So,
My pleasure, Dan. I wish you all the best with the new podcast and everything, and be glad to come back if you have some more questions or something you want to talk about in the future.
all right. Sounds great. Thanks a lot.